Do you ever wonder where really wealthy people keep their money? Do they put it in their checking account, their brokerage account? Do they constantly buy assets with it? Stocks, bonds, real estate investment trusts? Do they put it into a trust fund for their kids, for the generations below them? The answer is yes. Recently, Goldman Sachs did a survey of the ultra rich to find out where they keep their money. Now, ultra rich, I'm talking about 10 million plus in assets. There were some interesting things that came out in this survey. Let's take a listen.
Absolutely. So let's dive into this. What is the number one trick that you see a lot of ultra high net worth individuals deploying to make sure that they're not just achieving millionaire status, but maintaining it over time?
Yeah, thanks for the question. In our work with very large family offices, we find that two key themes sort of emerge in their approach to investing. One is their ability to take risk, and the other is their ability to bear illiquidity and be patient from a very long-term perspective. We find the investors we work with maintain a large allocation to alternatives. We recently did a survey of 170 global family offices that reflected that the average allocation to alternatives is 44%. As our investment strategy group recommends broadly to our ultra high net worth clients, that recommendation for alternatives is closer to 25%. But many of these families have a multi-generational investment lens. They have other sources of liquidity in their portfolio, and that tends to drive these biases.
Okay, so say I'm not an ultra high net worth individual. I'm just a net worth individual, and I'm trying to invest or at least position like a ultra high net worth individual. What is perhaps the proportional mindset that I should have in order to perhaps bring this into a more kind of bite-sized element for my own investing strategy?
Absolutely. I think the overarching principle is having a plan and an asset allocation framework. The second is diversification, because ultimately, if anyone takes concentrated bets in a certain position or a certain asset class, it can be not the right approach long term. And then I think the main thing is being invested over a long period of time versus trying to stock pick, because ultimately, one, you have to pick the right time to enter. If you sell, then you have to pick the right time to re-enter, and you pay taxes along the way. And so our recommendation to investors is to be diversified and think through the long-term approach to investing.
So two of the things you saw highlighted there were portfolio diversification and portfolio rebalancing. Now, these are very important. And let's talk about diversification first. I mean, this is investing 101. You want to be diversified. It's really difficult when you first start out to not just say, okay, why don't I just put all my money in the top performing sector in the stock market, which is tech. Okay, so I could buy a sector ETF, let's say the Vanguard Tech Fund, VGT, okay, which is a big holding that I have. You're going to make 17 to 18% a year. That's its CAGR, its compound annual growth rate, which is the best performing sector over a decade in the S&P. The broad S&P, you're going to make about 12% a year. It's very tempting to do that, very tempting to do that sort of all-in YOLO type of investing mentality. But the thing is, it's not going to be that way every year. And depending on your timing and when you need money versus when you don't need money, it could put a monkey wrench in your whole plan for the future. If you're just about to retire and let's say something happens like, I don't know, a major worldwide virus, like that would ever happen. Let's say that happened and the stock market tanked. If you're not diversified and you just lost a ton of money in any individual sector you were in, for example, tech, which got hammered during COVID-19, then what? You always want to have diversification. Now, the second one was portfolio rebalancing. I rebalance my portfolio at the end of every year. Now, some people like to do it at the end of every quarter, okay? Every 3 months, some every 4 months. Some people will do it 6 months into the year, or if there's some major change in the market. Personally, I like every year. I don't want to trade. I don't want to do too many moves. I don't want to adjust money back and forth between different sectors or different assets. So I like taking a whole year approach. What performed well this year? What is going to do well next year? Do I have too much money in one thing? Do I have too little in something else? and then I'll do a rebalancing. Now let's take a look at what else came out in this survey.
So what the ultra high net worth individuals also do really well is compound their returns. Where are the kind of early benchmarks that one could set up for themselves to make sure that they're just having a good rate of compounded return over an extended period of time?
Yeah, I think it comes back to diversification, which is the key. But as you think about long-term equity exposure as an example, the S&P 500, which is a market-weighted index, is a really good proxy for that. And so to see how the S&P performs over time with the construct of a diversified portfolio, I think makes a lot of sense.
How do I resist the urge to say, I just want to outperform the S&P 500 every single year? I want to make sure that the S&P 500 is not even in the same stratosphere of the returns that I'm getting on my investments.
Yeah, I think, you have to look to money managers and professionals to do that. It's not, stock picking is not easy for the everyday investor to do. But what we think, markets are pretty efficient. There's a lot of information out there today, and so finding asymmetric information in return has become harder. So we actually see that investors look to their alternatives portfolio as an opportunity and a mechanism in the portfolio to actually outperform because you have a longer time horizon. And as companies are private, you may have an edge in terms of what information an investment manager can access versus what companies report in the public markets.
You mentioned alternatives. What is the hottest alternative investment that you see ultra high net worth individuals piling into right now?
Yeah, piling into, there's a lot of the family offices we work with are pretty balanced in their approach. Private equity within the alternatives ecosystem remains the largest allocation of that 44% number I mentioned. That stands at about 26%. Given the multi-generational lens, venture capital and sort of the hub for innovation is a really interesting area of the portfolio as well. And then real estate, you think about your portfolio, what's the goal? Let's beat inflation. And so real estate is an important segment of that portfolio as well.
Okay, you heard her talk about using the S&P 500 as a benchmark. Now, most investors do this. Just about everybody in the world looks at the S&P as a benchmark. It's 500 of the largest, most traded companies in the largest economy by far on earth, the United States stock market. So the S&P makes about 12% a year. That's its annual growth rate. I look at everything and compare it to that because it's well diversified. You have 500 stocks across 11 different sectors of the economy. So because of that, I will look at any new possible investment, let's say in emerging markets ETF. Okay, do I want to invest in emerging markets? These are up and coming countries that are recently industrialized, places like Brazil, Chile, what China was about 15 years ago, India to some degree, places that are becoming more high tech and more industrialized. So I'll look at their stock markets. What are they doing? If they're making below 12%, I'm not interested because I can stay well diversified and buy the S&P and make 12%. So why do I want to be in something lower? Now, if you listen to the beginning of this video, you're going to say, well, Nico, what about diversification? You want to be diversified to a degree. That doesn't mean you want to have a piece of every single part of the investment community across the earth. Okay, I'm not buying stocks in Japan just because I want exposure to the Japanese market. I don't care. I want to make the biggest return I can with the least amount of risk. So just like you heard her say in that video, you want to use the S&P as a benchmark when you're looking at other things. When I look at ETFs, I want to compare those ETFs to the S&P, whether it's the emerging markets like I just said, or something else. So there you have it. Where do millionaires, ultra wealthy millionaires keep their money? They keep it invested because they want to return. They want to use their money to make more money. You don't need to be a millionaire to do that. In fact, I hate the separation. People are just, they're enthralled at how ultra wealthy people live, but they're just people. So you can live like a millionaire on your way to becoming one. Invest your money. Now, earlier in the introduction, I talked about just money to live. Do millionaires keep a lot of money in things like checking accounts? Well, that can go one of two ways. Some people like to have a lot of money in a checking account. There was a poll recently where ultra wealthy people are keeping sometimes up to $50,000 in a checking account just as a cushion in case they need it. It gives them sort of a peace of mind having that money there. And then there's the other side, which is the side that I'm on. I like to keep the least amount of money possible in a liquid account, like a checking account. I only keep enough money in there to pay the bills that I have on a monthly basis, which for someone like me is not much. But it could go either way. The amount of money millionaires keep in a checking account, like I said, is personal, depends on preference. You don't get a competitive interest rate, so your money's not working for you. Now, earlier I said some people, it's a psychological thing. It makes them feel good to have a chunk of coin sitting in there, but other people like the bare minimum, and they keep most of their wealth in more lucrative assets. So there you have it. That's where the money is. Keep as much invested as possible. If it makes you feel good, have a liquid account, like a savings account or something like a checking account, which probably only gets you 1% interest. Keep some money in there if it makes you feel good. And if you do have some unexpected things that come up. For me, if something came up and I really needed money, I would use my credit cards. But everybody's different. Make sure your portfolio is diversified. Do some rebalancing. Make sure you look at it on a regular basis. Think about your past performance and what you want your future performance to be, and account for any major changes in the stock market. So, where's your money right now? And where do you plan on putting it when you become a millionaire?